Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 448. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
And life insurance adjacent products.
Yes, all of the accessories. And we came today to talk about Pac Life's IUL and Kyle Busch. No, we didn't do that.
But we may at some point.
Yeah, we could. We could in the future. Good. So hang tight. And instead, come in and listen to us talk about annuities.
Yeah. Yeah, well, first we got to wait for that story to develop and all the hate to come out so that we can talk about all the people that are hating. We got to see what lies they tell in service of their own narrative. And then we'll have more to say.
Yeah.
I'm accumulating them, by the way.
You have binders full of I told you so's?
I don't know about binders yet, but I got some. So annuities, which actually are a life insurance product. A lot of people don't realize that, but they are.
They are a life insurance
There you
product.
go. Well, there's the podcast.
Them, I think.
So
they used to. There. Okay. Yeah. Look, annuities have been really, really popular for the past couple of years.
Mm-hmm. Way more popular than they were
really
for the
popular.
preceding 15. Yeah.
If we look at the life cycle of annuities in terms of modern time, and I'm going to say modern time being like the 2000s to now.
Yeah.
There are many people who disagree. I even like to disagree a little bit, but we're going to call that modern time. So you get this big ramp up in excitement about annuities. You get this big ramp up in large part because of its excitement after all of the Fed policy and the market collapse of 2008 and things that followed suit from there, because annuities held stronger interest rates than other fixed account options did in the wake of the 2008 financial crisis. So there's a lot of excitement then for annuities. It waned as prolonged low interest rates existed.
Yep.
And definitely diminished year over year. Then we get to COVID, we get a reversal in interest rate policy and a massive, massive resurgence of annuity interest because we suddenly had a lot of the features in annuities in terms of interest rate payments or income benefits that didn't go away, but they weren't as strong as they were in this kind of moment.
Yeah.
If we go back to like the 20 teens.
Yeah. Yep. Yeah, I would say this is a generalization, but from 2008, 9 until 2021 was sort of a dark period in terms of new features in the annuity space. They kind of plodded along.
Saw a lot of.
They weren't bad, but like you said, the income benefits didn't really. They were there and they were good. They were fair given the interest rate environment we were living in at the time. But they were not, setting anyone's hair on fire. And they didn't innovate as much as they did in the period from say 2001 to 2008.
Yeah. Yeah. I mean, there was a period in that time frame, again, before, even kind of during and a little bit after the financial crisis, I'll move the goalposts a little bit, where you could buy things like indexed annuities and get a 30 to 50% bonus paid on your initial premium.
Yep.
And then you could get a compounding 8 to 10% on that for the sake of creating an income bucket.
Yep.
And that was mighty, mighty attractive in terms of what that could create as a guaranteed lifetime income to you if you deferred income for like 5 years.
Yep.
So that looked really good, but that went away.
Rich. Yeah.
Yep.
Sorry,
that
we're
went away.
talking
The
over
bonuses,
here. I think
especially,
the internet has
declined.
a delay in our connection. So
that's okay. We have weird mannerisms that would happen even if there wasn't a delay.
I'm trying to excuse it, but
so in more recent years following COVID, we got a revival of these big bonuses, these great accumulation income bucket features. It really put annuities back in focus for a lot of people. Mm-hmm. Because now we have this opportunity that exists for a number of people reaching retirement to shift some of their assets into annuities and take advantage of the income benefits that they provide that didn't exist a few years prior and may not last for very long in terms of what you can get into as an option. I don't mean they'll go away and the people who buy them won't be able to use them. I mean that the opportunity to do what you can do today with an annuity might not exist this time next year.
Right. I would say there's a greater than average chance that would be the case.
We have already received communication from some insurance companies that this trend is headed in that direction. And we have a number of things going on broader economic wise. We have Fed rate reduction decisions. We've got rumors about the revival of quantitative easing. So those are all things that are going to push interest rates down across the board.
Right.
And when interest rates get pushed down, annuity features become less rich.
Yes, that is true. And they annuities react very quickly to interest rates.
They do. They are a lower margin product. So they cannot artificially inflate annuity benefits. And there are some companies from states like Ohio that learned if you don't move quickly to economic conditions, then that can cost you dearly when it comes to the expense of a block of annuity business.
Yes. Very true.
So given all this, we are here to basically just say that we think coming for the next couple of years, there may be the regret setting in about the fact that people didn't jump on the annuity they were looking at, or they didn't do more of the annuity that they decided on, because we don't think these current income features that are available are going to continue to be available.
Right. Well, the features themselves will probably stick around as they have been, but what am I trying to say, Brandon? The multipliers, the percentage,
the magnitude
calculations. Yeah, exactly. What often is a no-brainer nowadays will not exist a couple of years from now. Assuming interest rates continue on a downward trajectory. That's the big thing. Who knows?
Yeah.
But
correct. We've shown in a few situations that you can take an annuity right now, and if let's say you defer income for like 5 to 10 years on the annuity, you can generate guaranteed lifetime income from that annuity that would require you to get something closer to a 20% annually compounding return on the stock market.
Yep.
To match that same income benefit using the kind of typical style of the way those things get modeled. Accumulate a certain balance, you withdraw 4%. You would need a massive rate of return to accumulate the amount of assets necessary to match what the annuity is going to do, guaranteed from day one.
Right.
There is no question. We are not unsure. We know that when an annuity has an income rider benefit on it, so we're not talking about annuitization here. We're talking about things like fixed indexed annuities that tell us you get X bonus at inception, and then you get Y percentage every year that you defer income for a certain period of time. That we in that situation, we are absolutely guaranteed from day one what the income benefit will be whenever we choose to start income in the future. So if we're planning to wait 6 years, we know what it's going to be. If we're planning to wait 8 years, we know what it's going to be. And that number is mighty hard to match in a typical just 60-40 portfolio in the market.
Right.
That is something that I don't think is necessarily going to become untrue completely, but the amount of income that you get, and therefore the rate of return you're going to need to be able to accomplish to match it, they're going to start to compress.
Right. Yes.
And that's going to make what you can get out of a current purchase of an annuity become less attractive, I think 12 months from now.
Mm-hmm. Mm-hmm. I agree.
So there's unfortunately a number of impediments that stand in people's way when it comes to their decision right now to buy an annuity. And a lot of them are really, there are a lot of noise, a lot of kind of useless noise, if you will.
Mm-hmm.
Because people get hung up on the very traditional things like annuities have fees or annuities aren't all that liquid. You have to relinquish the control of the money as a result of buying an annuity. But if you need income, you're always going to have to relinquish the control of the money.
That's right. Well, you and I have made the argument for years when people, have said that sort of thing. It's like, well, the problem is that if you just keep dipping into your bucket of money because you need money, then eventually your bucket runs dry. So at least with an annuity, it's a controlled thing, in that you get a certain amount of income every month, and you're going to get that until you die. So of course you can't and or shouldn't put all of your money into annuities so that you don't have liquidity for other things. But certainly, having a portion of your money be illiquid is not the worst thing. In fact, it may be good. I know that's heresy, but
That's a very good point, and there's two things to address with that. We'll do the last one first. So, not having as much access definitely forces you to think about how significantly important this expenditure is.
Right.
Yes. So, if something comes up and you decide I need to withdraw an additional $10,000. If it's always just money sitting in the market somewhere, and you're just selling shares when you need the money, that's not going to have as much an impediment as, well, I've got certain money that's set inside an annuity that I really can't touch because that's just income. And now I think I need an additional $10,000, which means I go to this other pot of money that's now smaller because I bought the annuity, which means, in theory, every remaining dollar is a little bit more precious because there's fewer of them. That can certainly cause people to think a little bit harder about whether or not this $10,000 distribution is significantly important.
Right.
If it needs to happen.
Yes.
And to the earlier point that you made, which is you shouldn't put all of your money in an annuity. And I don't understand why this isn't something everybody just assumes as a default. And look, we've had some situations where people have come to us and said, we basically want to take all of our money and buy an annuity.
Yes.
And we want to do that because the income that it will provide will give us a budget that we can work with.
Right.
And those people are not common, but they do exist. And okay, if that's your headspace, we can talk through that. But for the majority of people out there, an annuity is simply a fantastic way to create foundational income in retirement.
What is foundational income?
So, if you think about your income needs in retirement, some are non-negotiable. They're things that you just have to pay. And yeah, Social Security will hopefully play a critical role in covering some of those expenses. But most people will have income needs that go beyond that. And these aren't things that you want to find yourself in a position where you need to pay the whatever it is expense, but now is not a good time to sell the asset that you own that you were planning to sell to raise the income.
Right.
So using things like annuities is a great way to provide yourself with the income to do that and not be forced to sell other assets at inopportune times.
Right.
And we're not alone in this sort of positioning. There's pretty ample research done by people who spend more time doing research than we do that have shown that using this sort of approach maximizes not only income ability, but lifetime wealth accumulation as well.
Yeah. Well, I mean, I think it fits really well with most people in the way that they are going to receive income from an annuity in the same way that they got a paycheck when they work. So
yes,
it requires the same level of mindfulness about budgeting, and the security of, well, we had some things come up and we're a little tight this month, but we're only 2 weeks away from the next paycheck. So,
yeah,
we can do it. Like, everybody's had those times in their life where it's like, well, I could dip into my savings, but I don't have to. We can just tighten the belt a little bit here, for the next couple weeks.
Yep.
And there's another payment coming. So I just think that sort of serves people well who have worked for an every other week paycheck or once a month paycheck for their entire careers.
And there's so many things about that. Like as you mentioned, people are accustomed to just receiving a paycheck, which is what annuities can basically replicate. You get paid. It'll be once a month. Some people are used to that. Some people are used to basically every other week. But whatever it is, like a systematic drop of money is something most people can work with.
Yep.
And why try and reinvent the system at 65 or whatever the age is to now live your life in a completely different fashion when you don't have to? And why ditch a system that served you well for 30, 40 years?
Yeah.
That you already know how to work inside. Retirement is going to be a very, very big change in a lot of things. It doesn't have to be regarding the way you approach income and monthly budgeting.
Yep. Very true.
And it's easy to gloss over how much this approach will stop you from doing potentially disastrous things with your money.
Yeah. It's funny, something I was thinking about
because
in preparation for this,
yep,
is that just really a generation ago, if you think about it, maybe a generation and a half, if you want to be technical, most people who retired lived on pensions. They had their pension and they had some Social Security. And most of those people, you and I have known quite a few of them, both in our families and in our working career. They didn't have a lot of money outside of that. I mean, they had other money, but it wasn't, you didn't meet a lot of people. This is what I'm trying to say. You didn't meet a lot of people who had a pension of, say, $2,000 or $3,000 a month, who also had $2 million in a brokerage account.
No, you did not.
Right? You met a lot of people who had $2,000 or $3,000 a month from their pension, maybe $1,500 or $2,000 a month from Social Security, and maybe $150,000 in savings accounts and CDs.
Yeah, maybe.
Yeah,
maybe.
And so,
yep.
And now it's like it's just odd to me. I don't know that I have a point here other than to point out the obsession with liquidity now. People accumulate $1 million or $2 million in their 401k, and then they become obsessed with not buying an annuity or not doing something that's illiquid that will provide an income with at least part of that money because they got to maintain liquidity. And I mean the financial industry compliance industrial complex. Oh, see what I did there? Has also become obsessed with that.
Yep. It has. And it so much so that like somebody could buy an annuity and they could use a lot of their money to buy that annuity and create an income that is sufficient for their needs on a month-to-month basis. And like 6 years later, they could run into an emergency expense that they don't have ample reserves for because they just don't. They could have not spent as much of the annuity income, or they could have not withdrawn money from other accounts as much as they did. But whatever the answer is, they didn't. And lots of times, there's this finger wagging at the fact that they were sold an annuity that removed liquidity. And had that not happened, they wouldn't be in this crisis.
Right. When the reality is, had that not happened, they probably wouldn't have had any money at all.
Exactly.
I mean,
they would have spent it some other way.
That's just as likely a scenario, is my point.
And to your point, when it comes to like financial advisors, because there's a lot of people who market themselves as advisors and they leave it very open-ended to basically suggest that they're gonna take you under their wing and tell you everything you should do with your money. They face zero criticism when a client of theirs misspends the assets.
Right.
As long as it's not something they sold them that put them in this position, they have no responsibility.
Right.
But there are times that people are rescued from that behavior when they use certain financial tools. And it doesn't necessarily have to be annuities. It could be some other asset that is bought just for its yield, bonds,
right. Sure.
some sort of ExxonMobil for the dividend or whatever it is. That might stop them from actually selling the position. And it might stop them from being able to create immediate liquidity in a crisis.
Right.
And we like to really put a negative spin on annuities for that reason. Mm-hmm. But we don't necessarily get mad when somebody invests in some sort of asset that they lose money in. And then the crisis comes and now they don't have the money because there was a reduction in the market.
Yeah.
And while there are some circumstances, there are some circumstances regarding suitability and timeline that would have an opinion there. But assuming someone had a longer time horizon, but they lost their job, at that point, we don't really worry about the liquidity issue.
Right.
Which is somewhat unfortunate.
Yes.
Lastly, I do want to address, because I think this is something that gets brought up in a lot of financial circles, and I very much empathize with the consuming public on this one, the complexity aspect of annuities.
Mm-hmm.
And I actually think that in a lot of cases, the complexity is a little overblown in the sense that a lot of it comes down to terminology, which isn't complex, it's just new.
Yep.
Like, if you spend a little bit of time wrapping your head around it, it makes sense. It's not deeply, deeply complicated. It's just not something you're familiar with immediately. But the notion of how annuities accumulate benefit is, especially income riders, is basically through this additional account that grows in value, but you can't take that value away from the annuity. You can only use it as a basis for a withdrawal that's guaranteed.
Mm-hmm.
And there's some unfortunate misinformation that gets peddled about how that works sometimes among agents and even financial advisors. I remember being very, very new to the industry and watching another person in my own office basically try to convince somebody to buy an annuity with an income rider, telling them that, hey, you give me your money, I'm going to guarantee it grows by 7% every year. Mm-hmm. And it's like, yeah, that's not how that works. But and look, when we talk about annuities with people, we're technical, so yes, we get into some of the details because a lot of the people that we talk to just want to know for the sake of knowing. But when we talk really broadly about annuity options, we don't get deep in the weeds about this one's going to pay you that bonus and do a roll-up of this. Instead, it's, look, you put $100,000 here, you wait to take income for 6 years, you're going to get this much money as a guaranteed income for the rest of your life. That's how it works.
Right.
And if you want to know how to work backwards and reconcile that, we can go through that conversation. But don't try to compare company A and B in terms of their bonus and the percentage that they're going to pay you, because that's never going to make any difference. What you really want to know is who's going to pay you what if you defer till this point.
Right.
That's all that matters.
And we focus on that because we believe in most cases, you should be buying it for the income.
Oh, yes. So
that's the most important thing to focus on.
Yep. Because all annuities that aren't SPIAs or DIAs I guess technically a DIA does too, but SPIAs for sure. Cash value will exist.
Right.
But cash accumulation year over year in an annuity, outside of MIGAs that are bought maybe because it's a better rate than the CD would pay you, are generally a very, very, very limited use case.
Yeah.
Like very few people go out and buy a floating rate annuity, just fixed annuity, or a fixed indexed annuity, or really even a variable annuity, just because they want to accumulate cash value in the annuity.
Right.
Those situations are not super common.
Right.
Most people are buying them because they have some sort of income capability.
Yeah.
Now, even those ones that do have income capability, variable annuities, fixed indexed annuities, as an example, they will accumulate cash value over the years.
Sure.
And you can think of it as kind of a plan B. What happens if I get to the point that I thought I was going to start income and I decide I don't want income and instead I just need to take the money and do something else with it? The plan B exists.
Yeah.
But it's always a pretty lousy plan B. It just
it's not
is.
the greatest generally.
Because the accumulation of cash is not going to be that strong. It just
and the one caveat being there are some annuity products that are better at accumulation, but they typically don't have the same income benefits and other benefits attached to them.
Yep.
They tend to be stripped down to make them more cost effective. I mean, to be honest, it's not any great mystery. The goal is accumulation, so that's what we're going to give you more of, and we're going to give you less of all the other guarantees. So,
Yep. That is true. But they are not the 100% solution in every situation.
No.
And not everybody roaming the earth should own an annuity necessarily. I think that there are a lot more people who could benefit from using them as, again, foundational income. But that is kind of the primary reason most people would look at annuities.
Yes.
And it can even go a little beyond foundational income, for sure. I mean, some people may be trying to piece together how they're going to go about making income, and the income that they could get out of an annuity for X amount of dollars is more than they're going to need on an ongoing basis, but a little bit of margin to deal with things like inflation, or just because we might have some other expenses that we think are going to come up. That's all fine. That's nothing wrong with that. But people aren't going to buy all of it, or put all of their money in an annuity, rather. And believe me when I tell you, there are reasons to believe that what you can get out of an annuity today will not be as good as will exist a year from now, 2 years from now. And I do think there's going to be a number of people who look back and go, that was a really great opportunity to lock in some guaranteed income.
Yes. That's why we're doing this episode, because we know that's going to happen.
Yeah.
There are going to be people who miss out.
That's our point. Yep. And so the siren is blaring. Don't miss out. That is our message.
Indeed.
And I think that's all we came here to say.
All right.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.